Hi everyone, welcome back to Phillip Roundtable. I'm Walun, the moderator for today's session. 2022 is a messy year. As we recover from COVID-19, the Fed is undergoing probably the most aggressive monetary tightening in history, causing the borrowing costs to increase significantly. At the same time, we are troubled by the high inflation that erodes consumers' buying power. This afternoon, we'll discuss these issues in the context of the global financial stability. Before we begin our discussion today, let me share with you the panelists for today. We have 3 panelists today and 1 will join us later. First of all, we are happy to have Ray Chow with us. Mr. Ray is a senior sales manager in the intermediary sales team, Southeast Asia for Fidelity International. Based in Singapore, Mr. Ray is responsible for growing the retail distribution business across the Southeast Asia region. He joined Fidelity in 2022 and has accumulated over 6 years of experience working in the asset management industry. Prior to joining Fidelity, Ray spent 6 years as a business development manager in the intermediary business team for Schroders, Singapore, where he specialized in the distribution mutual funds and development sales and product strategies. Mr. Ray started his career in Schroders as a management associate in the distribution business and rotated in various roles with product and investment desks across London and Singapore. He holds a Bachelor of Science degree in economics with a double major in finance from Singapore Management University. He is also a CFA charter holder and holds the investment management certificate with CFA UK. We are also delighted to have Ms. Mutiara binti Zulkifli from Phillip Capital Management Sdn Bhd. Ms. Mutiara joined PCM in September 2020 as a fund manager. Before joining PCM, she was a portfolio manager managing Dana Morphim in Phim Asset Management for more than 2 years. During her tenure there, she also covered sectors such as auto, aviation, REITs, conglomerates, manufacturing, consumer staples, as well as overlooking various portfolios foreign countries exposure. Prior to joining Phim Asset Management, she was attached to Phillip Research Sdn Bhd as an investment analyst for 3 years. Graduated from University Technology Mara with a Bachelor of Finance, Ms. Mutiara brought with her over 6 years of experience in the capital market industry. She currently holds a capital market representative license. She is currently the designated fund manager for PCM for 11 funds with exposure in Malaysia as well as overseas. Our third panelist today is Mr. Wu Mentai. He joined Principal Asset Management as Head of Investment Services in June 2018. He was previously the Head of Investment Management and Products with M Private Banking. He brings with him nearly 30 years of experience in the financial industry since 2000. He has been served as a portfolio manager for both international and domestic equities. During his early careers, Mr. Wu was an investment analyst, having worked with a few global investment banks. So without ado, let's begin our session today. We start off with the most concerned topic for this year, the global inflation. And so this is the first question. The US inflation is down for the 5th consecutive month on a YOY basis. Do you think the inflation has already peaked in the US? Ms. Mutiara, it would be great if you can share with us some insight. Ms. Mutiara, can you hear us?
Yes. Good evening, everyone. Okay, I think first and foremost we need to establish that US inflation has indeed dropped from the peak of 9.1% back in June earlier this year, and then it went to 8.5, 8.3, 8.2, and now it's at 7.7 that we're seeing right now as at end October, which is quite encouraging number. But to know whether or not this inflation number has peaked, I think we have to still go back to the June 9.1% inflation data, and you know, to understand what has transpired to actually push the inflation number to this 9.1% number. So I mean, if you recall what has happened during the period is that firstly, EU has actually agreed to a ban of the Russian crude import, so that actually helped boosted oil price to an all-time high of over $120 per barrel. And then secondly, you also have to remember that during the period, China has actually announced a gradual economic reopening post a 2-month strict lockdown in some of its key cities such as in Shanghai, Beijing, Chongqing, Guangzhou, etc. So that actually also propel a spike in demand from everything, from commodities, food, services, consumables, devices, and that also helped in a sense push inflation data to 9.1% during the period because of the intertwining economic dynamics during the period. And then secondly, I think you also have to dissect the inflation data of US. We see US CPI, 1/3 of it is the shelter component, and then 20% is energy, 40% is the food prices. So as we all know, shelter price hasn't even peaked yet. It's still on a rising trend given how interest rate how aggressive the US has been increasing its interest rate. So shelter price also followed suit and has been rental growth has been very, very strong, up I think 30 to 40% from 2019 level. And then we can say that even though energy price has tapered off from the peak, but there's also a wild card in the picture such as China reopening story, which may or may not happen in 2023 or 2024 period, as well as whether or not Ukraine-Russia war will be prolonged. So these two wildcards can actually be one of the determinant factor on the inflation number moving forward. So I won't be so quick to say that inflation numbers has peaked because we are approaching the winter season, and then during the period energy consumption will increase a lot as well. So there's a lot of moving parts to this, so I wouldn't rule it out so quick just yet.
All right, thank you, Ms. Mutiara. Mr. Ray, how do you think about this issue?
I think first and foremost, good afternoon, everybody from Phillip Capital. My name is Ray, representing Fidelity. I share the broad consensus view with Mutiara, so alluding to a lot of the points that she has brought up. Fidelity view is that we do think that inflation is likely to decelerate over the period of next 6 to 12 months, and I think we can offer and also observe some signs that inflation has been decelerating. If you take a look at some of the supply chain disruptions that has been occurring in the past 12 to 18 months, we're starting to see it ease. This is assisted by lower new orders. We're seeing a weakening demand. And if you take a look at commodity prices, which has peaked somewhere in the middle of June, until the middle of October, we have seen it coming down by almost about 15%. Some of the key signs we do observe is also that money supply has been a very strong driver for inflation. If you do remember, 2020, we saw a large amount of money supply being pumped into the system because of the COVID crisis. Now this huge spike in real money supply is already behind us. We do observe that quantitative tightening has already begun. If you look across the world, major central banks are already buying back the bonds to support. They have been buying back bonds during the crisis to support the financial system. I think today you do see that they all have announced plans to sell off the bonds that they bought. Again, I think if we delve into the financial conditions across the globe, you do see that bond yields have risen a lot. US 10-year is now trading close to about 3.8%, where it was just at 50 basis points in June of 2020. So that is a fair reason to believe that a lot already has been priced into the markets. At the same time, if we look at the fixed income space, we have seen credit spreads widening by a lot. US IG spreads have risen from about 80 basis points last year, June, July, to about 145 basis points today. And at the same time, if you take a look at the dollar strength, DXY has risen from about 90 in mid-2021 to about 107, 108 now. So again, a lot of these conditions contribute to the factor that it will make financial conditions a lot tighter than before. And it has gone above typical levels when inflation starts to come down in the past. So based on that few reasons, we do think that inflation is likely to decelerate. But again, alluding to Mutiara's point, there are a lot of moving parts in the economy. So again, we are closely monitoring.
All right, thank you, Mr. Ray. So, Ms. Mutiara and Mr. Ray, can we say you are still cautious on the inflation figures in US moving forward?
Yes, I would say so.
Mr. Ray, how about you?
I do agree, and I think it's again important to monitor some of the financial conditions, which will give us a sense of where inflation numbers will be moving.
All right, thank you. So, but on the contrary, while US inflation has been easing, the UK and EU inflation data are still breaking multiple decades record despite deteriorating economic activity. Can we say there's no chance for the UK and Europe to avoid a recession? Mr. Wu? So, I'm sorry, Mr. Wu. Mr. Wu, we cannot hear you clearly. Can you speak louder?
Is it better now?
Yeah, it's better. Thank you.
Okay. If you do not have enough energy to run your economy for industrial production and the like, not to mention the geopolitical war, I think you will definitely have issue with your economic activities. And even though you may have demand, but you do not have the fuel or electricity supply to allow you to produce as much as what the customer want, you will see a contraction in your production. And contraction in production means lower value added, lower value added means you use a little shape unless you can pick it up from somewhere else. And not to mention the fact that they are financing the conflict, right, that has happened between Russia and Ukraine. That is a great drain on the resources. So I would believe Europe as a whole, economic condition will definitely slow down a lot. Don't be surprised if it contracts, right? But the question to ask is how much will contract by? Because the latest IMF forecast as of October is still talking about a 0.5% growth for Europe next year. Although personally I think that is most likely not achievable. But for the EU it's going to be a contraction of 0.5 or anything less than 1%, then I would say it's relatively high.
I'm sorry to interrupt me. Mr. Wu, we still cannot hear you clearly. Can you?
Is this better now?
Yeah, it's better this way.
Yeah. That's the question, because if you may have a contraction in your output, so it's a matter of now whether it contracts by -1 or -0.5. There's a major difference in your economy as well as on the rest of the world. For me, I think Europe economic activities definitely will slow, likely to contract, but the question now is how much will it contract? Right, that's what it is.
All right, thank you, Mr. Wu. Mr. Ray, how do you view this issue?
Largely speaking, I do agree with a lot of the points that Mr. Wu has made. I think in Europe, the base case for us is that there will be a recession, and I think we have maintained this view ever since all of the geopolitical tension that we have seen in Ukraine and Russia break up. I think the most important factor here is again the natural gas situation. It continues to remain very stressed, and I think even though we're seeing a bit warmer than expected weather the last few months has given a bit of breathing space to certain European countries. If we take a look, if we zoom in into each and every one of these countries, we do see that there's an element of industry rationing occurring in some places. This will help to maintain high reserve, but there will likely be more stress as we approach winter. But if you go into the hard data within Europe, I think there are two sides to the coin. If you take a look at performance of European equities in the last couple of months, you do see that European equities has performed relatively better after the ECB signaled a very slight dovish stance in their pace of increasing rates. But again, if you take a look at the economic activity in the Eurozone, in the month of October, the PMI has actually declined and has fallen to 47.1 from 48.1. Preliminary estimates have showed that, again, Eurozone's Q3 GDP growth has slowed about 20 basis points quarter on quarter, registering the weakest expansion since all of the pandemic restrictions has been lifted in 2021. If we take a look at October inflation numbers, it stands at about 10.7%. So all of this business activity decline is kind of pushing us towards a view that recession fears continue to grow. But again, if you take a look at some of the corporate earnings that we have seen in the third quarter of 2022, we have seen close to about 65-70% of earnings being disclosed, and a lot of companies have managed to deliver quite a strong top line and also a healthy earnings beat. I think according to some of the research that we have seen, almost about 59-60% of companies have beaten consensus expectations at the top line, with around 20% of companies delivering better than expected EPS. So again, I think all of these noises about recession and also inflation concern, they will not go away. Ultimately, the European Central Bank, they recognize that the growth shock will be severe, it will be longer lasting, and already this gas problem might not even be solved by the next winter. So we have seen a lot of fiscal austerity in the UK, and this could make things worse. It could push inflation numbers even higher. And again, on the other side of the other side of the coin, you do see that earnings have been strong for European companies. And I think in our approach towards European companies, bottom-up selection is extremely important, and I think we continue to stay, I would say, conservative this region.
All right, thank you, Mr. Ray. So we talk about inflation, and it's always linked to terminal rate. The US Fed funds rate has gone up 375 basis points in less than 1 year, and is projected to increase another 50 basis points in the December FOMC meeting, a further 50 basis points and 25 basis points in February and March next year. Do you think a terminal rate of 4.75 to 5% as traded in the futures market is sufficient to bring down inflation? If not, how high do you think the rate need to reach, and when do you expect a period of monetary tightening to monetary loosening will occur? Mr. Wu?
I would put it this way. We are generally seeing the impact.
I'm sorry, Mr. Wu.
We have generally seen the
Yeah.
direct impact of higher interest rates. We have seen a lot of US companies saying that they will slash staff. Intel is among the first few to do that. But we have yet to see the full impact of staff slashing. Because companies like Intel have thousands of subcontractors supporting them, not only outside of the US but inside Asia as well, in US as well. So that slowdown effect has yet to be seen. And now we have Twitter, old Facebook, Amazon talking about it. So I think it will, to some extent, cascade through the technology sector to some extent. The other impact that I'd like to highlight is that the impact from quantity tightening, which at this point is not exactly well documented yet. Because since 2008 until recently, there were periods, a short period whereby it was drawback and then it came back because of 2020. The US have been flooded with free money for a long time, and a lot of entities survive because of all this free money, and all that is now being reversed, and we have yet to see any tangible impact. And I think the most tangible impact would be the bankruptcies, all right, and perhaps the unemployment rate. So for me, there are a lot of things working, but we have to wait for the effect to finally surface. I think this may also explain for why when Powell is talking about the recent statement that he's willing to consider not doing 75 basis points anymore, because a lot of this impact have yet to be fully fit through the system. And if the number come out and surprise you on the downside, if the market would be actually be happy about it, I think that is very, very debatable. Although a lot of people say now bad news could be good news, but when it's lower than you expect, then I think that's when the reality sets in. And at this point, we have yet to hit ground zero on all these. So, to some extent, I support the way the Federal Reserve is managing and guiding the market. I like the way that since March, when they tell people, they guided the market on how many increases that will be done. That actually is a total change from last 50, 60 years of monetary policy guidance. We have not done it before. So I think that also tells you the caution that the Fed is doing. We can say they are very aggressive, raising by 75 basis points, but then there's no choice. Inflation is above 8. They have to be aggressive. But they are fully aware that, I think we are talking about very experienced policy makers, long histories, well documented. So I think to some extent at this point, I would look to their guidance rather than trying to be too smart.
All right, thank you, Mr. Wu. Ms. Mutiara, what do you think about this?
Okay, I do concur with Mr. Wu with his points, and I think what I want to put it out there is that what I say is more on a near-term to medium-term assumption, and at this juncture, I do see that inflation number has tapered somewhat from the peak, and that is partly thanks to US Fed doing its traditional method of controlling the demand via successive 75 pips of interest rate hike, which is very aggressive. But to your question, even following these 5 consecutive months of decline in inflation number, I don't think it will carry, and I don't think it is too early for them to pivot and change course, because a lot of things haven't even cascaded into the numbers yet, like what Mr. Wu have mentioned, and I think they still need to stick to their guns and carry on with the interest rate cycle. But I do agree that the fact that they are less hawkish this time around, and they are open to the idea of slowing the pace of interest rate hike, and while they monitor the demand in across sectors. So I think to your question, at what point do you think they will pivot? I think with what's happening globally, what is happening right now is a 1 in 100 years kind of scenario, where we have a Russian-Ukraine war, where we have China zero COVID policy, where we have US-China trade disagreement, and then we have this 2-3 years long pandemic. All the bad news are jammed into 2 years time frame. So I do want to give a benefit of the doubt to the US Fed, and I think that what they're doing right now, monitoring how the economic conditions are doing before deciding what to do further moving forward is a good move. And then if you look at the sentiments on the ground, how the housing market has started to cool down, how sales also how house prices has started to drop in the US, and then how there's massive layoff across sectors such as in tech sector, in banking sector, Also, if you listen to the recent Walmart earnings, how even the top high income earners has started to trade down. They have started to buy cheaper options to try to adapt to this high inflation environment. So all these sentiments, all these numbers, and all these scenarios, I think, are some of the things that the Fed should monitor and should consider before deciding on the next course of action. So they have to properly monitor how all the cascading after effect. Only then it will be wise for them to pivot and reverse the cost of the interest rate hike.
All right, thanks, Mutiara. inflation seems to have peaked, whereas the interest rate is approaching the peak. Can we say the market is near the bottom or already past the bottom? Mr. Ray?
I think, again, if you take a look at the growth outlook, we do see all of this hard data as pretty depressing. And I think if you take a look at the future activity trackers and also some of the weakness that we have seen in China, overall, I think the generic story continues to go along the lines that inflation is already becoming more and more entrenched in our economies. As such, I think central banks are really keeping a very huge focus firmly on inflation, which is why we have seen several tightening of financial conditions and also increasing and almost like a risk-off environment in financial markets. We do expect, and markets do expect, rates to peak at around 5% and potential cuts perhaps to kind of come in after the second half of 2023. Over here at Fidelity, we do broadly share the same similar view with the markets. However, we do actually remain a lot more defensive in our multi-asset views. So I think if I could dissect the question, we talk about market nearing the bottom or past the bottom. I think it is important to look at it from an asset allocation standpoint. If you take a look at it from a multi-asset lens, you do see that there are various opportunities that we can take advantage of. Duration is starting to look a lot more fair. Growth outlook continues to slow, and I think some of our clients that we speak to are actively looking for duration as well. From an equities point of view, we're slightly underweight equities. We do prefer US equities given that it's a lot more defensive. In Europe, again, as we have alluded in the earlier questions, it is facing its own unique challenges from the energy crisis. So we do prefer USA in the equity space. I think within credit, if we take a look at that, we are preferring to be positioned an overweight meaningful position in investment grade versus your emerging markets credit. And I think where you see some of these corporates with a stronger fundamental, stronger flow, and it will again see certain challenges because of the stronger dollar, which historically has been a headwind for emerging markets credit. So overall, I think we do think that inflation is starting to get more and more entrenched. But going ahead, I think we need to be extremely disciplined in our approach. And I think at times like this, where markets are volatile, it is always good to fall back on your asset allocation views.
All right, thank you, Mr. Ray. Mr. Wu, what do you think about this issue?
For me, I think the worst thing to happen is inflation may drop, but may not drop to the level desired by the central bank. And you still have a little bit of growth. So you have what you call a textbook type of so-called stagflation issue. And unfortunately, it's a vicious cycle if you ever reach that. So that will actually mean you need to bring interest rate, crank it up higher to break that vicious cycle. You need the economy to go for a clean break. That means a more severe recession to break that cycle. I hope that does not materialize. At this point, based on the data and based on base effect that we have seen, inflation rate in US should start to come off, especially by middle of next year, a lot more, unless the core inflation side refuses to come off, which is the higher wage rate and all that stuff. But with the level of firing happening, I think that may be okay. So for me, I think the most important part is not to let go of the steering wheel. So there are people out there who says the futures market in US will say, interest rate may be cut in the second half. They may be proven wrong, because just to ensure that to bring inflation to the desired level, I have no idea what's the desired level, but I would believe that anything below 3.5% or below 4% will be acceptable. All right, and if it does not reach that level, I think this is where I think the central bank will continue to increase rates. All right. and they are willing to sacrifice growth because of that. But nevertheless, if we go on the fact that the unseen, untangible, uncalculated impact of QT, base effect, higher and aggressive interest rate stance that we see now does work, then growth does slow. I think if things like first half of next year is when all the bad GDP numbers come out, then the central banks or the Federal Reserve will have to focus a little bit more on the other objective, which is to sustain growth as long as possible, other than maintaining inflation at an acceptable level. Then that's where the forward market expectations of a rate hike would happen. But if you expect an aggressive drop, that I'm not sure. All right. The question now is, of course, if U.S. economy to slow down, the same question arises: would it be at 0 or negative 0.5 or negative 1 will determine the aggressiveness of how fast the interest rate will be cut. That will also affect on your asset allocation. In equities, some part of equities would love lower interest rates, some don't. But bonds definitely love lower interest rates. So you have an asset class that provides a more clearer trend. But I would like to stress for bonds, the focus have to be on investment grade first, because you still have the uncertainty of a recession in the developed countries. So there is a constant flow of bad economic news, and you do not want to be in high yield when that is still present. I guess you will only go into high yield or something riskier when, after interest rate cut, people start talking about US and Europe start to come back, maybe by second half of 2024 or whatever the timing, then perhaps you want to consider that. I mean, this is at this point the way I look at it.
All right, thank you, Mr. Wu.
Adding on to Mr. Wu's point, there's something that I want to bring up is also policy divergence. I think if you take a look at the eastern part of the world and the western part of the world, we are seeing very aggressive rate hikes in US and ECB with the UK. But at the same time, we're looking at China's really on the opposite trajectory. So again, I think depending on where this pans out and where inflation numbers guide us, we will expect very different monetary policies as well.
Okay, thank you.
Allow me to add a little bit on that. I know that China at this point is on the so-called moderate path or mildly loosening path. And to some extent, the latest COVID numbers seems to have postponed a little bit on how they want to refine or retune their zero COVID policy. But assuming a month or two from now, given this peak in their or rising cases of COVID in China start to come off, then you have to ask yourself that the Chinese government is always very, very cautious. And once they are able to get generally the economy back on track with the reopening, because the reopening means people are willing to hire new people to expand capacity, because you don't want to be hit by a lockdown in your city and you just expanded your capacity by 50% and you hire 3,000 people. All right, so that will bring a little improve the stability of economic activities, like what you see now. Because post Shanghai lockdown, everything jumped back for a while, then everything started going down south again. But once things to stabilize, you must expect the Chinese government to stop a general softer policy approach. They will definitely adopt a more targeted policy, economic policy support group type of policy support, which the market may or may not like it. This is again something that one have to seriously consider. Although this may only happen in second half of next year, but market nowadays 6 months or 3 months in the market is considered quite a long time. So this is just something for food for thought.
All right, thank you, Mr. Ray and Mr. Wu, for the insight. The yield curve has been inverted for quite some time. Does it mean recession is unavoidable, Ms. Mutera?
Okay, I mean yield curve is a good indicator, but it is not the perfect indicator of a recession. See, like what I mean, the other panels have spoken earlier on, how the mass layoff in the tech sector, also paints a picture of where the market is going. But we also have to watch what is the job opening level in the US especially. Job opening level post-pandemic has actually not subsided. Actually, job openings in US is around 10 million as at end October, and an unemployed person is around 6 million. So if you look at this ratio, so there's 2 jobs for every 1 single unemployed person. So it's pretty much an employee market right now. So putting that into perspective, even though there's a huge layoff in the tech space of about 50,000 people, 50,000 is actually just a dent, hardly a dent in a 10 million scope. So the people still have the money to spend essentially. And even if you look at the stimulus check that was being given out by the government earlier on, some people still have the money, they have not fully utilized the money. And the fact that we always talk about recession, it gives you a mindset that I have to start saving. So that is one of the reasons why people have stopped splurging in a sense. But if you look at the cash level in their banks, the cash level is still very much higher than where it was pre-pandemic even. So that is one thing that we have to look at. And then if you look at the savings rate in the US, for example, savings rate is of course quite low, and now it's around 3% versus the peak around 30% during pandemic period. But couple that with the stimulus checks that they still have in their accounts, actually it's not that they don't have the money, but just that they choose not to splurge, like what I mentioned earlier. So that alongside with the robust job openings, despite the mass layoff currently happening, I think recession is not 100% unavoidable. Also, there's also the wild card that what Mr. Wu had mentioned. Let's say China suddenly started to reopen their economy, maybe on a gradual scale. But as long as it is on a reopening trend, the market will react positively to that, and it can actually reverse the cost of recession at stabilize the economic stability.
Thank you, Ms. Tiara. Mr. Ray, what do you think about this yield curve being inverted?
Yep. I think on the note of recession, if you take a look at all of the broad-based house views of investment houses, you do see that many houses have already put recession as a base case. When we take a look at a yield curve, I think historically it does provide a very good guidance of whether there will be any market corrections, whether there will be weakness in growth and economy. Yes, it has a very high predictive power, and the inverted yield curve that we have seen today have suggested that there is a higher chance of recession. But if you take a look at it from another view, it also shows you the sentiments of all of the market players. Essentially what the market is saying right now, that it is doubting the Fed's ability to continue push rates even higher, as they have suggested, as Jay Powell has suggested. If we take a look at the data, I think future markets have showed that investors do expect Fed to maybe pause the terminal rate maybe in the first quarter of 2023. Over the last few weeks, the June 23 to June 24 rate futures have become inverted with about 90 basis points of cuts priced in. This is essentially saying that markets are stating that they don't think that rates will be able to stay at the Fed's terminal rate for very long. We are already seeing some signs that inflation is decelerating, as we have discussed. Recessionary indicators are starting to flash. The short end of the curve is again going up a lot quicker than the longer end of the curve. The 2-year, 10-year has inverted by close to about 70 basis points, which is actually the highest that we have seen since the 1980s. So again, I think if you take a look at it from that perspective, we do think that if we look beyond all of the risks of a global economic slowdown, which continues to be very prevalent, essentially market is doubting that the Fed and think that it will likely have an easing policy maybe as soon as middle of next year.
All right, thank you, Mr. Ray. So now we move on to China outlook. The China's purchasing a manager's index PMI has dropped below 50 in October 2022, signaling a contraction. At the same time, the factory output and retail sales data in China has also missed the expectation, where the factory output grew by 5% and retail sales dropped 0.5%. What is your view on this? Is China market still an attractive country to invest into? Mr. Wu?
Let me put it this way. The PMI number is a pure quantitative indicator. And with your rolling lockdown across the country, no companies will want to even seriously consider expanding capacity or hiring somebody. And actually you will be like thinking, okay, I'll do business as long as I can. If there's no cases reported in my city, that's fine. If there's one case, I get locked down. I mean, that was and I think that's what created the downtrend post the Shanghai jump in the PMI. All right. Next, we have to consider for China how they want to manage this, because of the way the rolling lockdown, everything have created pretty high unemployment rate for the country for the first time in many years. And I think unemployment among the youth 16 to 24 years old group is now more than 20%. This is almost doubling the level, more than double the level before the 2020. China always have a relatively higher unemployment rate among the youth, partly because every year they have something like 3 to 5 million fresh graduates, and to absorb the 3 to 5 million new supply in the marketplace will take some time, even though your economy is growing strongly. Not to mention the last couple of years, you hardly absorb any new people at all. So that's where you have the more than 20% unemployment rate. I think that to the Chinese government, the policy makers, this is their largest headache at this point, right? And because of that, that means there's less people spending money but nobody earning money. One, that is that lack of confidence. Nobody want to do anything. Even though I still make good money every month, I would not go out for my, some people like in my family, Monday to Friday, we will cook at home, Saturday we will go and eat. But because of such changes, you'll say, okay, no way, man, Friday, Saturday we also stay at home. And the other impact that is now to some extent is impinging on the Chinese consumer confidence level is the volatility in the property market. You have the people, house buyers refusing to service their mortgage. There is one particular statistics that was told to me that for an average household in China, the property they stay in contributed 70 to 75% of their total net worth or total worth. So when 70 to 75% of your property is having some so-called perceived issue, and you are still paying mortgage on it, you definitely will not be spending money. I think this is where the Chinese government needs to strike a balance to continue to grow the economy, with balancing it with how they want to do the lockdown COVID-19, and together with what's the environment outside the world. Not to mention the fact that post-2018, the trade war, the so-called political risk premium that Chinese market faced, how people value the Chinese market would to some extent also bring down the overall average valuation of the Chinese market before this. And post that, after MCO, the move to have a China +1 or China +2 supply base will provide a different drivers to how the Chinese economy can grow. And what it means is they need to drive it domestically even more, rather than FDIs. Well, of course, certain FDIs cannot go to China anymore because China has reached a stage whereby their wage rate is already high. And effectively, then you'd ask, where it goes. But what it means is that the Chinese will be much more innovative in terms of how they want to sustain growth, to generate jobs, generate income, to ensure that they continue to grow, because you can say China is the second largest economy in the world, but I think their average per capita income is about almost 10,000 US, and 40%, 560 million of the people still earns about 15,000 renminbi a year only, an annual income. To some extent, I wouldn't even consider China as a middle income country by virtue of such a statistics, even though on a per capita basis they have crossed that threshold. So there are a lot of other things to consider within the China space and how they want to handle their policies. Thank you.
All right, thank you, Mr. Wu. Ms. Mutiara, we would like to hear from you as well on this issue. Ms. Mutiara, can you hear us?
Yes, sorry. Okay, in a sense, yes, China is very much domestically driven, but I do sense that, I do get a sense that some of the companies in China are actually expanding aggressively overseas, and they have been doing very, very well. And I mean, this is the kind of sectors or counters that you should be looking at in China, as instead of going into China, counters or sectors that are just purely domestically driven. For example, I mean, we talk to companies such as Pax Global, which is expanding not just in China but also in America, in ASEAN countries. And the growth of their, the revenue keep on growing very, very strongly because of this expansion of their business. So the companies in China that is moving towards this direction, trying to expand business outside of China, will continue to do well. So that is one of the highlight I think I would like to mention. Because if you want to, as an investor, I wouldn't think it'd be wise for you to just write off China from your investment universe because of the recent policies that was imposed. Because if you back to before COVID, where is China? We have to look at it that way. Because China, as a country, is very much they have a very strong foothold in certain sectors such as gaming, e-commerce, software, pharmaceuticals, auto, a lot of sectors. And if you look at these sectors specifically, even like recent Alibaba's single day sales, GMV has is up 2.9%. Despite such COVID challenges, despite how the market is going, they are still getting growth figures in their single day sales. What does that mean? 2.9 may not seems like a big growth, but if you look at the number cumulatively, it's around 70 billion US dollar. So how would one? I wouldn't advise any investor to just write off China and say, oh, it's an uninvestable country at all. And then looking at all these PMI numbers, actually it hinges on their very strict zero COVID policy. But I also think that you have to look at this zero COVID policy on like a sort of like moving average kind of event, because prior to September they didn't mention about all this reopening, shortening of a quarantine period and so on. But now how they are moving in this policy is that they're trying to the quarantine period has been shortened from 7 plus 3 plus 4 to 3 plus 4. It has been shortened quite considerably. And then in terms of some of the travel agency, some of the airlines have actually indicated that they are increasing the flight routes to double or triple than last year. So definitely you see that they're moving in the right direction. They want to reopen the economy, not like they don't want to open. But what is actually making them to take a step back is because of the lack of natural immunity in the country. A bulk of the population, around 90% of the population in China is already have their second vaccines. But in terms of booster, they are lacking behind their counterparts. So also in terms of number of cases, it's still very, very low on a percentage level. So because of this lack of natural immunity, that is what is stopping them from reopening on a grander scale. So they will opt for more gradual pace of reopening. And then moving back, like what I said earlier, so when the reopening team start to come in, let's say in first half of 2024, and then plus the sectors or the counters that are expanding overseas, the counters that are doing very well domestically and also overseas. I mean, these are the kind of things that you should look into when you invest in China, not just not just focusing on the domestic driven names. I think the other day I saw this China counters called Li-Ning. They opened a store in Pavilion, Malaysia. So I mean, that's a move in the right direction. They are doing what they should do. They should be doing.
Yeah, thanks, Tiara. The People's Bank of China and the China Banking Insurance Regulatory Commission has recently outlined 16 steps to support the downfalling property sector in China, and this is viewed as a comprehensive measure that provides credit support to the housing developers and to increase liquidity. And many property stocks skyrocketed after that. Do you think this is a fundamental change for the property market or just a flash in the pan, Mr. Ray?
Yeah, I have been monitoring the high yield markets, especially when we talk about property sector. A lot of them fall under the Chinese high yield space. Just this year alone, I think we have only had 2 positive months. November hasn't ended, but November is one of them. And the last one was in August. China's regulators have clearly told financial institutions to start extending support to developers. And I think if I could just jog your memory and you look back and think about 2021, where there were regulatory crackdowns on private tutoring, TAL education, new oriental education, they used to be the poster child of this sector. But again, I think at that stage in time, a lot of the managers across the world start to see private tutoring sector as something as uninvestable. What we are seeing today is very different from what we have experienced in 2021. We are seeing a lot of positive signs. So the 16 measures that you have brought up earlier is again another positive move towards a gradual improvement in the sector. So the National Association of Financial Markets Institutional Investors will be expanding bond financing by about 250 billion renminbi only for private companies. Internally, the view for China and China property remains largely the same. We do think that slowly but surely this space, this property market will slowly start to become a state-owned company-dominated segment where the government themselves can carefully monitor both the supply and also the levels of leverage. Pure investment demand is likely going to be squeezed out. The Chinese party have already emphasized this many a times this year, and I think more focus will be placed on public housing to fulfill demand. The end game is that we do think that China economy will gradually pivot towards a model that is less reliant on property development growth. Within the Chinese property sector, I think the key question that comes to mind to a lot of investors is where will we start to see a good recovery in a sense. We need to first see how some of these supportive policies are being implemented. I think if we take a look at some of the developers' liquidity, we have been very encouraged that some of the onshore developers have again been allowed to issue bonds with financing provided by larger banks. Over the long term, I think this will be key. And another key point will also be the recovery in activity in the physical market. I want to allude to Mutiara's point, and I echo her point that over the longer term, I think there will be significant risk if you maintain a long-term underweight to China. China has always been a diversifier, especially in the bond market, and I think this will be a large benefit because most of the credits that you see in the developed world is highly correlated. We are also now in a position where market risk reward situation has become a lot more attractive, and we see a lot of main drivers of recovery heading our way. Overall, I think we can expect a bit more volatility in this space. Again, we could see a drawn-out recovery hinging on the pace of physical property market recovery and how all of the restructurings of your defaulted Chinese developer turnout. We have seen policy easing in a few cities and also a slight rebound in physical market, which has slowed since third week of November. But those are key positive points and olive branches handed out by the central banks and also the government. Base case, I think to summarize all of that is that we don't think that the Chinese government is trying to erase or destroy the property markets like what we have seen in 2021 to the private tutoring space. This is a key segment of the economy. Land sales is a primary revenue for local governments. Property-related loans represent about 30% of the total financial system. So add all of these facts up, I think we expect to see a very guided process that will help moderate the restructuring and the recovery in the Chinese property space.
All right, thank you, Mr. Ray. Ms. Mutiara, do you share the same view?
I quite agree with what Ray has mentioned earlier. I do think that the Chinese property market will need some time to consolidate. The market. I mean, it won't be a quick one. The supply and demands of the housing market will need some time to reach a balanced equilibrium. And then we know that China has been echoing this. House is for living in, not speculative purposes. So this is very key and very much in line with its common prosperity theme. So, following this theme that China has been putting priority of late, I think banks, developers will need some time of adjustment and need some time for them to deleverage. But what is key is that as long as, like what Ray has mentioned, as long as physical market activity hasn't fully rebounded, the risk is still there. You see, for property developers to reduce their inventory, to clear off their inventory, to deliver their projects, and people on the ground, when you want to purchase a house, you have to have a living wage, right? You have to be able to carry on with your work. You have to be earning wages. Only then you even consider or open to the idea of buying a house. But if the economy does not allow you to do that, the economy does not allow you to work, does not allow you to earn a living, why would you be thinking about buying a house? And why would that improve the property condition in China in the first place? So the fact that the China government is very proactive in this sense, trying to guide the property companies, holding their hands towards this direction is a good direction and it is a good improvement. But the market has bottomed last year, and any gradual improvement is a good sign and it is a good news to the market. So we have to monitor this improvement. And it is very good that Ray brought up the point that we have to monitor the data that is like the land sales of the property market, the project delivery, etc. But year to date, the number hasn't been very exciting. I mean, commencement of project is very slow. Project completion also very slow. Land sales also down by negative 53% year to date, I think, if I recall correctly. But looking at this set of very, very negative number, the only way is upwards. So I'm very hopeful that the government can help, take the whole property market out of this slump. But I think it's a very, very gradual process. So I'm looking forward to that.
All right, thank you, Ms. Mutiara. China has recently eased its zero COVID policy. One measure is by reducing the quarantine days required for travelers. Nevertheless, China has reiterated their commitment to adopt the zero COVID policy and has called for the strict adherence of the policy. The market seems to welcome the initiative well this time, and China has relieved the policy and reversed course multiple times. Do you think this softened tone is firm this time around, Mr. Wu?
Let me put it this way. I think some of the so-called lockdown that has happened in some of the cities of China is definitely an overreaction. Because to some extent, you must remember that China is a centrally planned economy. A lot of flow of information and procedures come right the way from the top, and at the bottom, some of the lower ranked staff at the provincial level may have overreacted and just closed down the whole town. But in case it may not be necessary so. I think what the Chinese government have done is just to provide better parity and refine what they want to do. All right. Of course, reopening the economy slowly is fine. I think that's certainly something they need to do. But I do not think it will be a linear type of straight line situation. There will be ups and downs, like a market type of situation. Like now, suddenly cases in Beijing has so-called shot up. The important thing is to see what they implement in Beijing. If they don't lock down Beijing and only that part of town, that tells you exactly the so-called improved approach to handling the situation. And to that extent, that will also flow down to some extent people's sentiment and handling and allowing foreign travelers and all that stuff to go in and out, right? Because how they want to go about eventually people can get in and out of China, that is a major logistical planning issue. How they want to do that, right? But I guess this is a bridge that they need to cross, and I think they will need to think about it and how they want to go about implementing that. A reopening is definitely good for the economy, and this is also very important to some extent to slowly improve the sentiment and confidence level of the people. I say people unwilling to go out because of all this negative news, even though I'm working and still my husband and wife still working, but Saturday night in going out for my good dinner session. I just stay at home and boil my rice again. So this is, I think, make a marked difference in how things will look like next year for China.
All right, thank you, Mr. Wu. Mr. Ray,
Yeah.
for the same question, what do you think about this?
I think we have seen sexy dynamic zero COVID policy ease from 10 to 8 days, and I think that has also resulted in almost a risk-on environment that we have witnessed this month in November. There have been a lot of speculation whether China will end dynamic zero, but we do think that this is quite unlikely at present, because if you take a look at it, since COVID has happened, China already has been operating like this for almost 3 years now. Again, alluding to Mr. Wu's point, China will need to undertake a lot of due diligence. They need to make a lot of internal decisions in order to abandon it. And I think if you take a look at what's been coming out in the news this week, we have seen the first death in China for the first time in 6 months. We are seeing parks and recreational activities and museums being disallowed in Beijing, and I think within Shanghai we are also seeing a relatively tightening in all of these COVID measures. So again, I think it is almost very binary, like dependent on the extent on how well they can control the spread of the virus. I think also internally some of the authorities are maybe waiting for the World Health Organization to sort of declare the entire COVID pandemic as over, which we do think might come in 2023. This can be one of the triggers that might likely soften the stance at China, and I would like to emphasize that this will only soften the stance. We're not going to see China removing it within a day. China in the last 3 years has been looking for many ways to live alongside COVID, moving to dynamic zero COVID policy. I think most recently we saw that Beijing Marathon, which had about 20,000 people running with masks on. While I think some of the smaller communities, like Mr. Wu said, have locked down simultaneously. So we're going to continue to see such conflicting situations, smaller communities being impacted while the rest of the country goes on for normal. Positively, I think when we take a look at China's infrastructure growth within this space for COVID, we have seen a lot of build-up in COVID infrastructure, such as testing centers. Even if there is no end to dynamic zero, people will definitely find ways to live with it. Although it has already had its tangible effects on China's economy, but society, business, consumers, everybody in China, they are already living with it now. So again, I think our view, over the next 12 months, we might see an improvement in the policy, and this depends on various factors.
Alright, thank you, Mr. Ray. So now we move to the US market outlook. More than 24,000 tech workers across 72 companies, including Amazon, Meta, and Twitter, have been laid off this month. And Meta announced job cut of 13% of its staff, amounting to about 11,000 employees. What are the implications of this towards the US tech sector? Is it really the end of the boom times in tech? Ms. Diara?
Okay, this is a very interesting question. It's very debatable. Okay, I think what has happened, is something that is very much largely expected. You see, the layoff in the tech sector is premised on the fear of recession, and how if you notice during the pandemic period, how people have purchased laptop, purchase their tablet, their PC, because they have to work from home, they have to attend online meetings like what we're doing right now, and then kids have to attend online classes. So a lot of the purchases of all these mobile gadgets and tablets are very front-loaded. So people who have purchased last year, for instance, why would I be purchasing a laptop this year? Why would I be buying my mobile phone this year? I mean, it's still working very well last year. I mean, the normal replacement cycle is usually 2 to 3 years. So what the sector is experiencing right now is more of a normalizing stage, I would say, or more of a retracement stage, which is very healthy in any asset class. And if you look at the sector on a broader spectrum, if you put aside the PC segment, the tablet segment aside, there's a lot of new growth segment which is still in a very nascent stage. For example, the EV segment, which is growing very, very strongly. How the EU have actually has agreed to stop the manufacturing of ICE cars starting 2035, and then the data center segment has been doing very, very well because of how much data we need to consume nowadays. And then the 5G segment, the infrastructure is very robust and getting more and more robust. And then the IoT segment, Industrial 4.0, there's a lot of segments or pockets of growth in the tech sector that a lot of people are just turn a blind eye off to because of this slowdown in the PC and tablet segment. So what I think is that you have to look at the tech sector in a longer term time frame. Just because of a small blip and then you are writing off the whole sector and saying that tech boom is over is very, very wrong in a sense. And then what happened in Amazon and Meta and Twitter is more of a, they're trying to scale back on their investment. For example, Meta has been experiencing huge loss in their metaverse. So it's natural for them to scale back in light of how the market reaction has been, in light of the recession fear, in light of the amount of money that has been spent into the system, but it has yet to yield fruitful results. So, I mean, doing a business is always about balancing. When you overspend on a certain aspect of your business and you realize, I overspend, I may need to cut back a bit and spend on this other part of my business. So it's very natural. I mean, you cannot look at it on a very you cannot look at it to a too granular scale to the extent that you miss the whole growth of the whole tech sector. So I think tech boom is definitely not over. It's just a minor blip. It's healthy retracement. So I think any investors, this is the time for you to top up your investment, if any. When valuations of tech sector was around 70, 80 times, you want to buy it because the outlook is very exciting. It's a good segment to be in. But now when the sector has experienced a huge devaluation, good stocks are now trading at 20, 30 times. You don't want to buy it. You have to ask yourself, what is the purpose of your investment if you don't want to buy when the price is low right now? So I think, of course, I mean the concern is valid, but also have to look at a longer time frame of things.
All right, thank you, Ms. Tiara. Mr. Ray, do you think this is the end of the tech boom?
I like that you included Twitter in your question, because I've been looking through social media and I've been seeing a lot of indiscriminate firing because Elon Musk has taken over as the new CEO, chief tweet at Twitter. So that is also included in that number. But I think in general, very similar views to Mutiara. In a way, this is a positive thing, right? Tech companies, they are adapting very quickly and reacting more rationally to how market environment have been changing and how market investors perceive their companies. Google is doing a good job. They're keeping headcount flat. They're supporting profitability. The difficult market conditions now with rates going up, with inflation, do allow companies to make such reactions being a lot more reactive and rational, and keeping an eye on how many of their shareholders will react. Something important that I would like to highlight is that investing in tech is not just only about investing in high growth internet names. Tech, in fact, is a very, very diverse sector. It includes a wide spectrum of opportunities. So to name a few, we have software and services, which are typically higher growth, like your entertainment, streaming, gaming. You also have your supply chain, you have your tech hardware, equipment, maybe a bit more value and cyclical oriented, and not forgetting semiconductor and equipment, which has both a bit of a growth and a cyclical elements. So there are a lot of themes internally within our equity team. When you take a look at tech, there are a lot of various sub-themes that they are looking at, including 5G. We do expect 5G penetration to increase in the years to come. There's also artificial intelligence when demand continues to be strong. Mutiara mentioned about EV, and last but not least, there's also gaming and the growth of e-gaming, which has grown very, very quickly during the crisis. So I think overall valuations have come down considerably a lot in this environment where markets have seen volatile environments. Tech sector trading maybe around 20x. Right now it's lower than the highs that we saw in the tech bubble than in recent history. And even though on a relative basis, it is still trading at a premium to the other sectors, this is largely justifiable if you take a look at the balance sheet of the companies, look for superior growth profile, look for high margins, look for strong balance sheets, look for cash generation. That should give you a very good guidepost in investing in tech.
Thank you, Mr. Ray. The average 30-year fixed mortgage rate rose more than double this year as a consequence of the aggressive rate hike by the Fed. Understanding that the property market is cooling, could you shed some light on the outlook of the US property market in 2023? Mr. Wu?
For the property market to cool is definitely something, I think, as a consequence of higher interest rates. But if you look at it from a perspective whereby, for example, you stay in an area that is considered upper middle in US, somewhere, let's say in Palo Alto, right? The peak of prices in Palo Alto, if I remember, was somewhere in 2007, 2008. Then the crisis happened. I was there with a friend in 2009, and he says, "Oh, this house used to be, the last transacted price was 20 million US. It's a half an acre land, blah blah blah, and now it is auctioning off at 8 million US." And a few years ago, before MCO lockdown, the same house, my friend told me, is now almost 30 million. Post that. So for me, I think the way some of the prices in US have gone up is a lot, partly driven by very cheap financing, cheap housing, and you are finally seeing an end of zero interest rates, free money floating around. And I think if the property sector do not correct because of that, then there's something wrong. And of course, with the higher cost of money. So for me, whether you create an issue equivalent to what happened in 2008, I don't think so. but what it means is a lot of froth may be wring out of the system. May go sideways for a while, but I guess it's a healthy correction. I don't see any major issue with it unless the banks start telling you that they are receiving serious NPLs because of that. But we have yet to hear any particular news flow from there. So at this point, we'll take it as a normal market correction.
All right, thank you, Mr. Wu. Ms. Mutiara, what's your view on the outlook of the US property market?
Okay, to be frank, I'm no industry expert in this sense, but I do understand that a lot of experts in the industry do think that moving forward in 2023, they are expecting less buyer demand, falling house prices, as well as the higher borrowing costs. And I mean, it does make sense because if you look at it, how aggressive the US Fed has been with the tightening of their policy, and now mortgage rate is at around 7.1, 7.2%, which is very, very high and double that previously. So it's just a matter of time before you see house prices started to slowly and gradually drop. But if you ask me whether or not I expect it to fall like crazy, I don't think it's going to happen. I mean, I expect there should be certain level of cooling in the property market moving forward, but not to the extent that it will drop drastically. I mean, I have my reasons for that. Firstly, I think the supply of house in US is not as high as it used to be, or excessive as it used to be back when, I think, around 2010. So when house supply is excessive and mortgage rate was around 4%, and people can snap out houses like they snap out iPhones on the market and it's easy as that. But now the house supply is actually a lot lower than that in 2010 level. And then secondly, you also have to remember that following the huge wage growth that was experienced in last year through to this year, a lot of people balance sheets are better off, and also the banks and the lenders are very much more prudent in credit screenings, and that is why, like what Mr. Wu have mentioned, you don't hear a lot of NPL cases popping out in the property segment in the US. And then secondly, there's also just now we were bring how the US may actually reach its peak investment, may actually reach the tail end of its interest rate hike cycle by first quarter of next year. So then when they started to pivot, mortgage rate will start to fall back to a very healthy level, and purchases and buyer interest may actually come back and support this housing market. And also I think one trend that is not widely discussed is the rising affluence of the millennials in the US. So in the US, millennials around age of 23 to 34 years old actually made up a huge chunk of the population pie. So during the pandemic, around 40 to 45% of the house purchases were made by these first-time home buyers or millennials. So they are very much, they are very into this house purchasing, the idea of owning a house. And then I think given the recent wage growth, the millennials age group also one of the beneficiaries of this huge wage growth that was experienced by the US from last year through to this year. The National Association of Realtors pointed to a trend that moving forward, they don't think that the US property will drop drastically in any sense because of the huge support that is, or the huge purchasing power of this millennial age group. So I agree with that, and I think that is probably the case because if you look at the long-term trend of the property or house prices in the US, it has been on a straight uptrend line, except for last 2 years where it spiked up quite abruptly because of the pandemic. During the pandemic, the interest rate was near zero and people were buying houses, so house prices spiked up very substantially. But any retracement, if it happened, would be very good for the market, and it's a healthy retracement, and I think any asset class, it can happen in any asset class, not just the property segment.
All right, thanks, Ms. Mutiara. So now we move on to our last topic for today. Is on the quite interesting topic is on cryptocurrency. FTX, the cryptocurrency exchange, has filed for bankruptcy as it struggles to raise billions to stave off a collapse. As traders rush to withdraw $6 billion from the platform in just 72 hours, would there be a domino effect which eventually turn into a major crisis and affect the US market? Mr. Ray?
I would like to first declare that personally I am not an investor in FTX. But again, I think if you have been following the news that have kind of unfolded in the last few months, they have a new CEO now, John Ray, who is brought in to really identify all of the fraudulent activities that have happened in the company. And I think if I could remember the quote by John Ray, he did mention something along the lines that he had never seen such a complete failure of corporate controls ever in his career. I think to name a few of the very eye-catching, interesting things that I've read is that employees of FTX expenses, they were approved by emojis. And then if you take a look at some of the chats, they were auto-deleted, so nothing was kept. They never ever had a shareholder meeting, and again, I think it has been very challenging for investors to do their due diligence. The company also haven't kept any proper record, so it has made the job for John Ray very challenging. At the heart of the issue, which is your question whether it will result in a domino effect in the broader financial markets. Ultimately, we do see that FTX as a cryptocurrency exchange is not a financially important firm to that extent. If we take a look at asset class market capitalization, crypto, I think 21 hours ago, has just fallen below 800 billion US dollar in total market cap, the entire asset class of crypto. If we take a look at just equity markets, US equity markets is at around 46 trillion US dollars, or bond markets, global bond markets at probably close to about 140 trillion dollars. So again, I think the fall of this company in FTX is not sufficient and is not as I would say big a case to actually cause a domino effect. It is not an issue with crypto as an asset class or a financial system as a whole. If you really go and read into all of the court hearings surrounding FTX, you will see that it is actually just a complete lack of corporate governance. This is just the black sheep of the family. Again, all of these issues were further amplified because of leverage, sudden withdrawals from the clients. If anything, we do think that because of this occurrence, this will lead to a lot more regulations in the crypto asset class itself. And I think this, if we do see that in the near future, it will definitely make things healthier and also make it a lot easier for investors to do their due diligence when investing into cryptocurrency.
Thank you, Mr. Ray. Mr. Wu, what do you think about this cryptocurrency? Will it cause a major crisis in the market?
I would put it this way. If I read through when cryptocurrency was created a few years ago and through all of that, one of the reasons was because they said the US dollar is being debased. They are printing money like crazy, and and crypto is an potential alternative. And for crypto to develop to this stage, before all these things came about, have to come with the fact that there is sufficient inflow of liquidity into it. And if you notice that, just now I mentioned about the QT impact, unquantifiable part of it. I would be surprised some of these people who do a lot of this crypto thing who have taken a very cheap loan, plug it into crypto and have a good time playing around with it. And I think with the cost of money and supply of it totally shrinking very fast, This is, of course, one of the factors. Not to mention, of course, the complete lack of governance that Ray had mentioned, which for me is a total surprise, because you are talking about something that deals with other people's money. All right, I would thought that the governance, the whatever financial authorities will be looking at it very closely, even though it's an alternative investable class, but you are still talking about taking money from the public. To some extent, I start pointing finger, and I would agree with the fact that there should be a shake-up in how some of the rules and regulations will be written. Reporting and all that stuff in terms of oversight will be developed, and thereafter we will see how the cryptocurrency can re-emerge, whether it can really re-emerge and play a role as an investable class or not.
All right, thank you, Mr. Wu. That is the end of our session today. To wrap up, it seems that the US and China market are still attractive despite some risks are still lingering, whereas the Europe market is in a more troubling situation. On the other hand, crypto will need to be regulated. With that, we end this insightful discussion on the global financial stability. Thank you, Mr. Ray from Fidelity, Ms. Mutiara from Phillip Capital Management, and Mr. Wu from Principal Asset Management for your valuable insights. Goodbye and stay tuned for our next roundtable.
Thank you, everyone. Have a good day.
Good day.
Thank you.